Down has begun. On Monday, all hell will break loose, and what's about to hit will leave you completely speechless. I'm your host, Steve Van Meter, and thanks for joining me today. And our show today, Goldman Sachs warns that U.S. markets could massively unravel this week. I'll show you why the sell that started on Friday is just beginning. Because this is our Sunday show, the show that turns market data into dollars. We're about to break down the latest technicals, momentum, and machine positioning to boost your trading game, and more importantly, show you how to turn market chaos into dollars in your pocket. Now, let's first head over to Bank of America, because I want you to see what's been driving stocks for the last couple months. And then we're going to take a look at why Goldman says that next week could be the beginning of a massive correction. And then we take a look at retail and corporates continue to buy, as Bank of America notes that private clients were net buyers for the 10th consecutive week, while institutional and hedge fund clients were sellers. So we see a market where the professionals are saying.
So, God, I forget what that's called. The AAII Bull Bear Index. AAII Bull Bear Index. So this is something that one of the market wizards I worked with, Jason Shapiro, he's all about this, and he tries to find where they call it smart money and dumb money. I don't like calling those terms because you guys aren't dumb. Where the smart money and dumb money is going. And he may have a different measure that he's about to pop up here, but if institutions and hedge funds are selling while retail is buying, they're basically saying that retail is so stupid because hedge funds and institutions are selling. That's what it is here. If they're working together, then the retail is just as smart as the smart money. But if they have a divergence there, then the retail is just the complete opposite of the smart money. So I don't know where he's going with that, but I just want to point that out there.
Saying, you know what, we've had enough, we've made our money, we want out. And retail is saying, look, we think this is just beginning of something even much larger, and we want in, and we're going to buy at the all-time highs and continue to buy. And here we can see that private clients are often net big buyers in January, but keep in mind, institutional and hedge fund clients have both sold equities most weeks since the start of 2025. So since the beginning of the year, the Trump trade for retail has been driving massive flows. Well, again, the professional is saying, look, it's time to get out. And we can see that when we look at the equity allocation of Bank of America private clients. They're sitting currently at 64%, which, as you can see, is near one of their all-time highs, which was set back at 66% of their portfolio. And the evidence that retail is all in is very clear, as cash allocations are down to 11%. And this is one of the lowest levels in history, indicating that, again, retail is all in this market. And here's the real risk, because as we turn to gold.
That is concerning. I know we've talked about it before, that I feel like the complacency in the market has gotten to extremes. People just thinking we'll buy every dip because it always goes back up. When you look over the last couple of years, it's been 20+% for two years in a row. And just in 2022, the market was off, like, I forget how much. Let's go run the calculations real quick. The market was off how much? It was like almost to the day when 2022 started and hit that low down there. I feel like it was 20-something%. 27%. And yet people have forgotten that the market actually can go down. It's crazy. The market actually can go down. So, okay, I'm good with this. So far, I like it.
Goldman, and look at their tactical flow of funds from this week, we see that they're on correction watch. And Scott Rubner notes, he says, are we there yet? Well, yes, we are, as flow dynamics changed dramatically starting on Monday. Lots of incoming questions this morning on market technicals. He's on the lookout for an equity market correction. Let's take a look at why he says that. And one, retail demand is starting to fade after 10 straight weeks of massive buying. Well, what happens is retail starts to turn into sellers as it's time to pay taxes coming in March. And he said this is going to be one of those tailwinds against the market, but it's not.
I think also it's really important to pick up, and I noticed a couple of y'all had posted in the Discord over the weekend about how you're seeing more and more people talk about market breadth, right? I called the market breadth top back here on January 27th, and it's been just evaporating ever since that point. And so now I think a lot of people are starting to catch up and say, you know what, if there's less and less viable opportunities, then all that's left to do is sell. So, I mean, I'm not calling for a crash. I'm really not. But it seems like that's the case he's presenting here. Randy's sitting at 90% cash. He must be smart money. Alan is sitting at 80% cash. He must be smart money. I don't know. I feel like you need to go with what your trading plan says. Who would have thought? And so many people want to get on their high horse. I see these comments every single day. Hey, Chris, why don't you put your money where your mouth is and start trading something? Bro, my money is exactly where my mouth is, and that is in cash. And in fact, I believe one of the greatest traders of all time, one of my mentors, would tell you exactly to do that. He says, wait in cash for proper setups. How long? As long as it takes. So do you want me to like sit here and put my money at risk just to entertain you? Hell no, ain't going to do that. By the way, my name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where we save time, make money, and start winning with less risk together as a team. Now, later on, we're going to ask you to rank this out of 10, but go ahead and subscribe if you haven't already. Let's keep back to the video.
Not just that, even yearly retirement flows are running out of juice as January and February are typically the strongest months of the year for asset allocation. Now, as we head into March, those flows are going to decline. So we see now both retail flows likely to abate as well as flows into retirement products about to slow down. And what that's going to do is change the dynamics of the market in a big way, because what started on Friday had everything to do with machine positioning. I'm going to show you those critical levels, but let's first take a look at what Goldman says as they see a skew to the downside. So we talk about machine positioning. These are machines that trade momentum to the upside and downside, and when they hit their trigger levels, they are sellers and big ones. Over the next week, we see CTAs are net sellers of 14 billion of global equities. If stocks continue to go down, that would be 7 billion out.
Where do you get this data from? That you have these levels where people are going to be huge sellers of $173 billion versus buyers of $117 billion. Where are you getting this data from? Sounds interesting. I would love to have that as well, but just go with the trends.
Out of the U.S. So you see a heavy skew into the U.S. in terms of selling. But look at over the next month. If the market goes up, they're only buyers of 17 billion of global equities. But in a down tape, 173 billion global equities out, 60 billion of that from the U.S. And here's these key pivot levels. So let's take a look at a chart, because this is really important to understand. What happened on Friday is you saw the market started to sell down. And then what happened? It hit that orange line and the machines started to enter a sell signal and they started to unload their positions. Now, some of these machines, and it's important to understand, they will react during the trading day, but a lot of them wait to see where the market closes. And if it closes below that trigger point, well, the following trading day, well, then they're going to enter their sell program. And that puts the risk as markets slid right down to their 50-day moving average. And what's critical is they broke the 6-month volume profile. So over the last 6 months, we saw this is where most shares were traded, with people buying above that. If stocks continue to go down, you're going to see a lot of these people close out their positions. Now, the risk is we get down to this next level, which is at 58.79, and then you see a massive amount of selling off the second trigger level. Keep in mind, these orange lines.
Where are you getting this data from? I don't know. He may be 100% correct. Absolutely might be 100% correct. But I don't have that data to verify, and I don't know his source to verify it either. But I'll give you my perspective. I feel like the market is very weak. It has been weak for a while. And I've been telling you for ages, market breadth is one of the drivers as to why we aren't seeing the market be able to push higher over the last two months, not 2 years, but 2 months. This close underneath the 20-period moving average right here on Friday is a get the heck out of the market close for me. If I had any trades on at all, I would be in cash, 100% in cash at that level right there. Next, the 10-20 has not quite crossed yet. Price might close under the 50 right here. So we might have that outlier trend template start to point south, right? The 10 under the 20, price under the 50, which is why I want to start practicing, getting our chops ready to start going. And we very well may be putting on short trades later this week. Who knows? But in the meantime, just continue to hold cash, follow the trend. And the trend is weakening right now. The trend is weakening right now. By the way, just wanted to point out a couple of comments I saw were here. Cash is a position. It's so funny. People don't want to hold cash. I don't know why. Why not hold cash? Rick, same here. 100% cash. The power of sitting out. Nico asks, what's the average time on the market breadth cycle? It is very cyclical, super cyclical. In fact, if I zoom out, you'll see it's like 2 weeks up, 2 weeks down, 2 weeks up, 2 weeks down, pretty much continuously. But there are times like right here. This was in November of 2023 where it went down, came up a smidge, and then continued back down all the way until January of 2024 when it crossed back up January 22nd. And then after that, the cross back down was in March. So it can be a few weeks. It totally can. So there's no rush into that. If you're rushing in to trade anything, I don't think you understand the rules of the game. You need to wait, hold still, relax until you get your signals. And for this particular video here, for Steven here, he clearly is getting data from somewhere else I don't know of, and I can't validate. But so far, I like that he's talking about going with the trend and going with data. I cannot fault him on that. He might have a time machine though.
Rise every day. So as we see stocks goes down, that trigger point is moving ever higher. Now let's continue on, because what we see then on top of that, the options market is positioning that also suggests there's going to be more volatility. According to Goldman, dealers are currently long 9.8 billion of S&P 500 gamma, which acts as a market buffer when dealers are buying the dip. The problem is they're going to stop doing that because the bank's index trading team estimates that 50% of this long gamma position rolls off as of Friday.
Someone please explain to me what he just means by this. I know what gamma means, but I'm asking, can someone please explain this in like baby boy Chris terms, right? I don't understand what he means. Dealers are currently long 9.8 billion in gamma. In fact, let's ask ChatGPT. Hang on. We're going to take a screenshot and we're going to send this over to ChatGPT and we're going to say, explain this to me as if I'm a 9-year-old. Explain this to me as if I were a 9-year-old. All right, let's see what ChatGPT has to say. All right, imagine you're playing with a big pile of toy cars. I don't mean like that simple, but imagine you're playing with a big pile of toy cars. You and your friends are making them zoom around. There's one kid, let's call him Dealer Dan. Dastardly Dealer Dan, who has a special rule. Every time a car goes too fast, he slows it down. And every time a car goes too slow, he speeds it up, like to even everything out, I suppose. This makes the game feel smooth because there aren't any sudden crazy moves, just steady driving. Everybody driving the speed limit. Now imagine that dastardly Dealer Dan is using a magic power called gamma to do this. Right now, he has a huge amount of magic power, $9.8 billion worth. That means he's keeping things really stable. But here's the problem. Half of his magic power is going away on Friday. Hang on. Does that mean that they just like can't redo their trades? Like they expire, and once they expire, they're gone forever? No, of course they can redo their trades. They can replace the trades. That means next week, the toy cars, or in real life, the stock market, can move around much more wildly because dastardly Dealer Dan won't be there to keep things steady. So in simple terms, things have been calm because of a special rule, but that rule is about to weaken, and next week could be a lot more exciting or chaotic. Okay. I don't know if y'all have gotten that yet, but the okay, that's my like, okay, whatever you say, bud. Okay.
And the market will start moving more freely into next week. There's the risk that dealers now also not be in a position to buy the dip anymore as we face retail turning to sell into tax season. We see hedge funds and institutionals already selling, and now machine positioning has entered its first trigger point to sell as of Friday, and look for more of that selling going into Monday. So you can see now very clearly why all hell is likely to start breaking loose on Monday as we enter the
3 basis points so far. That's how far we're down. 0.02% at this point. 0.01%. Of course, I'm being a little bit pedantic. And of course, he was not recording this right now. He was recording it on Sunday. But I feel like he's taking the stance, and I could be wrong. I feel like he's taking the stance of, here's some interesting data points, and they're going to expire on Friday, so therefore they will end at that point. They're not going to put the trades back on. They're not going to roll the trades forward. It's just going to terminate at that point, and therefore market chaos. I could be totally wrong, but let's continue on.
Perhaps the potential now that the broad U.S. equity markets, which has been a safety trade for many investors, looks to now start selling down into what could be a massive correction. Let's talk about market breadth, because this is important to understand.
No way. Okay, hold on. This has been like my soapbox lately, and finally other people are talking about it.
And this is a percentage of S&P 500 stocks trading above its 50-day moving average, which is currently right around 60%.
Look at that. The percent of S&P 500 stocks trading above their 50-day moving average. That was exactly the metric that I used for ages. In fact, I think I still have a bookmark. Give me 12 seconds here. I certainly do. The MMFI. The percent of stocks above their 50-day moving average. How funny. How funny. Now, the thing is, like, this has plummeted recently, by the way. I have found the outlier breadth indicator to be significantly better. Not just because I'm a partner with Outlier, because I actually trade it, right? I shelved this because I found the market breadth here to be way, way more accurate to what's going on. Now, full disclosure, am I biased? Hell yeah, I'm biased. Okay, just putting that right out there.
And one of the reasons breadth is important is because we can go back to earlier this year. What did we see? The stock prices in black were rising as breadth was slowing. So more stocks were falling below their 200-day moving average, which was a very bearish signal.
Good question. What is the difference between the two? So the MMFI, the market breadth that he's using right here, this is the percent of stocks above their own 50-day moving average. So how many stocks that are in the S&P 500, right? So let's say 500-ish stocks. How many are above their own 50-day moving average, the red line? And we always talk about that being our longer-term moving average. How many stocks are above their own moving average? So if it's at 50%, that means half the market's above its 50-day moving average, half the market's below. With the outlier market breadth, this actually measures how many stocks have buy signals versus sell signals. Oh, I clicked the wrong button. 2 seconds. How many stocks are on the bull list? With 30 new ones today, 30 new buy signals. Or on the bear list where there's 78 new sell signals. And I'm going to give you a real pro tip right here. When this moves fast. I have seen 700 on the bear list in a single day before. Like it was like all hands on deck, sell everything kind of day. We're not there yet, but market breadth has been trending down since January 27th, right? 24th. And nothing has changed. I got the receipts. Go to the YouTube videos, watch them. I've been saying the same thing. And now people are starting to catch up, saying, oh my God, things are going bad, market breadth. Ah.
And eventually what happened, we start to see the market start to break down. And
Brian's one of our long timers. Brian was literally here from day one working with me. Brian is a rock star. Outlier is an improvement over MMFI and FinViz, hands down.
Respond to that. That is a very dangerous signal. Now let's take a look at our screens here, because what do we know? Momentum is negative. Now, how do we do that? Well, we look at a number of signals. One of those is a relative strength index. Now it's positive because it's above 46. Now momentum from its perspective will go negative under 40, but the MACD's got a negative cross. And more importantly, our proprietary overlay for Momentum Timer Pro, that triggered that negative signal, because momentum signals by themselves aren't super powerful. They're often wrong, but we run a proprietary overlay that looks at the overall trend and validates those.
I want to jump into, while he's talking about his proprietary overlays, let's talk about my proprietary overlay, my friend. We're going to go to SPY. The difference here is that I show you everything. I don't know what he's showing you other than a couple Word documents, but I'll show you everything. Anything you want to know, I got you. So if we go into the SPY, one thing that I picked up on, in fact, let me get in the last 3 months here. One thing that I picked up on recently is that the constituent heat map of the SPY. So imagine the 500 stocks that make up the S&P 500. How many of them are getting greedier versus how many of them are getting more fearful? And that's what this is measuring right here. You can see a lot of them were very fearful back mid-January, had been getting greedier, and then lately, the constituents, the pieces of the puzzle, hear me out, the pieces of the puzzle are getting less greedy. However, the market itself had been getting more greedy, right? The average itself. Now, the average is a market cap weighted index. So what that means is when we go to a map like this, the bigger it is, the more of an impact it has on the market. Okay. So that means that these big boys, right? Apple, Microsoft, Nvidia, Amazon, Tesla, Google, Meta, and Berkshire Hathaway, like they pull a lot of weight compared to everybody else. So when we go in here, we can see that the market itself, because of its market weight, actually had been getting more greedy, whereas the constituents had been getting less greedy. That was a huge divergence to me. I thought that was incredibly interesting. And that is one of the things with outliers, that we have so much data in here. It can honestly be more than you'd ever want to know, but you got to think of it from a holistic perspective, from a top-down perspective. What's going on in the sector? What's going on in the market? How many stocks are getting these buy signals? How many stocks are getting these sell signals? What's going on overall? Versus just looking at it myopically, big word of the day, which I'll probably get wrong, on a small horizon here.
Signals now telling us that the S&P, from a momentum perspective, headed lower. Now, you know, from a trading perspective, we have not had a position on this because there's been so many great opportunities elsewhere to buy.
Oh, interesting. He's saying he hasn't had a trade in a while. Me too.
low, and we've taken advantage of that. But look at our machine position. We modeled this based on historicals each and every day, and we see machines here 55% long. And because we run a historical overlay, what it suggests is machines indeed were likely to sell off, and they did. Now, this is our fast algorithm. This is our slow algorithm. And here you can see our momentum signals have shifted as well. Let's take a look at the charts here, because what we see is a very interesting dynamic. Let's take out those machine positioning lines, and what do we see based on the largest ETF? That is SPY. It came right down to its 50-day moving average here in green, right at its 6-month volume pro.
Yep. That's exactly what I'm saying here. And it bounced. Tell me these moving averages don't work. Like literally it wicked to where that 50-day moving average was and came back up. It looks like it might even close under the 50 here, which is getting more and more and more into Bart Simpson territory where we can eat my shorts.
Profile. So this is a critical level support. We would really need to see retail come in here and buying this. The problem is we see hedge funds and institutionals and now machines in their selling programs likely to push this down to the 100-day moving average. Now we could zoom out. We could see the 100-day has been a massive level of support. But again, what Goldman is noting here is that
I find it actually very difficult to see his charts.
Flows are skewed to the downside as we head into March. There's a lot of heavy buying in January and early February, and that starts to fade. And then, of course, in mid-March, we're back in the corporate blackout window. But for now, the corporates are buying and retail's buying, but retail's about to turn the other direction, as well as we're going to see institutions having to change their direction, as well as the gamma is flipping, not to the favor of investors, but to the favor of course, a downside move in the market. Now, if you're wondering how we trade so successfully, this is our CTA Time Pro. When we talk about machine positioning, we're going into Monday with a 91% win rate with 10 trades are up. Friday was actually a big win for us as well for our momentum traders. That's Momentum Time Pro is taking 12 positive trades into Monday with a 92% win rate. And again, how do we do this? Because we don't look to buy things that are high and hope to go higher. We look to buy things that are low and where we see a shift in either machine positioning or momentum. Now, if you want to start trading right alongside, start making money in these markets as we face chaos, hit the links in the description below, grab those 30-day free coupon codes while you're at it. Because now let's take a look at breadth when it comes to the NASDAQ, where we really don't get a very clear picture. But if we go back to January, we do see that breadth was on a massive decline. And what that eventually did was pull stocks, which are still trending upwards, and pulled them back down. But what happened is we went into February, we warned the breadth was falling.
This is so interesting. Finally, somebody else who understands.
Prices were rising. Then what happened? We saw the retail army come in and drive breadth up to 70%. And despite that fact, we're seeing a big move down in equities here. Once again, this could be the effect of retail going all in against the professionals looking to sell. This is a dangerous sign because we also have talked about how the analysts have keyed this market to sell. What have they been doing? They've been raising the bars that these companies need to hit. And we've talked about how when they want to see the market go down, that's exactly what they do. Well, who do those people work for? Well, you better believe the hedge funds and the institutions. They want to see markets go down as retail buys here. Let's take a look at our screens again. Momentum's negative. We saw that flip back on Friday with one consecutive now daily sell signal on our Momentum Timer Pro, giving our subscribers kind of a warning sign that maybe it's time to raise those stop loss levels and look to close out positions that are on the long side of the equity market.
Yeah, and I've been saying that for a minute, right? This close under the 20 right here, that if you didn't take this as a go to cash signal and you held through this, you might have made a couple bucks here and there. But another close under the 20 and a close under the 50, if you're holding in this market, you might be setting yourself up for a huge, huge headache. Not saying it's going to crash. I'll never say it's, hey, we're going to see the crash tomorrow. Or I'm never going to say, go down to catastrophe. All hell breaks loose on Monday. No. What I'm saying is, if the trend is moving down, if it's breaking through its intermediate term trends and then its longer term trends, my goodness, that ain't looking so good.
What do we see, though, for the RSI? Still at 49. That's positive. MACD, it's got a positive cross. The question is how long? But look at our machine position. We see selling across the board. And because we run a historical overlay, it suggests that we're going to see selling in the CTAs across the tech space. But momentum remains very stretched to the upside. Again, for how much longer? Let's take a look at the chart of QQQ here. And what do we see here? Nothing that really violates the uptrend yet. We really need to see it close below that upward trending white line. And let's zoom out to the one-year chart. You can see this has been very critical. Every time it's come down here or near there, for some reason or another, this is where investors are buying at ever higher levels. We would really need to see us break below the 50-day moving average in green. Right now, it's just below the 21-day moving average in red. But remember, major support here, 513.27. So it's not critical yet that we're going to see a massive sell-off in tech, but the S&P 500 could lead the way lower. Let's talk about the small caps because this got obliterated.
Oh, that's different. I have not been following IWM. Hang on. Learn to type, Chris. Hang on. IWM. Oh, man, I have not been. Who's been watching this? Look at that. Tell me order blocks don't work. By the way, these are going to be called outlier blocks soon. because we will have these inside of our platform, but you can't tell me they don't work. Look at this. This order block, November 12th, 2024, and then we go left, right? We go to the past, we go to the history books. Previous all-time highs said in November of 2021, they were waiting. They were ready, right? These are orders wanting to be filled, and they wait, and they wait. And what do you know? The very first time, the very firstest time that a price got up there, smash. The second time, oh, wait. I should have, hang on. The very first time I got up there, what happened? It got monkey hammered. The second time it got up there, what happened? I'm not going to do it again. But you get the point. Tell me order blocks don't work. And then when it comes down here, it bounced right back up. But yeah, oof. Small caps have been absolutely dominated lately. I want to see what he says about this.
We've been warning post-Trump trade that this was not going to hold. And let's take a look at market breadth here, because now we see 45% of Russell 2000 stocks above their 200-day moving average, telling us the small caps heading into a massive bear market. Now, what's notable inside that Bank of America report is they said that a lot of private clients were selling small caps to buy into those ever bigger magnificent seven. Again, you're putting too much money in seven stocks. The whole market now looking to be misvalued. As we see, breadth went down and Russell 2000 right down with it. And here we can see the RSI is at 35. That is negative in terms of momentum, as well as a MACD negative cross. We have 3 consecutive daily sell signals on our Momentum Timer Pro after one brief one right in the middle of this last week's trading. But we told our subscribers, we told you on the show, this is not where you want to be. And look at what machine positioning has been doing. It's been selling down. So as momentum slows and price goes down, the machines turn and burn and look to lock in their gains and get out. And sure enough, what do we see over the last 6 months as we draw across here the 6 months?
Dude, I'm just so stoked I found somebody who gets it. Like, how many other channels have we watched where they actually understand how the market works? This one, Felix does, although a lot of y'all don't like Felix. Felix gets it. The Financial Wisdom channel, right? The cartoon channel, they get it. I mean, it's only a handful of the handful of stock channels that actually get and understand how the market works. Honestly, this was a great one for me. John, thanks for speaking the truth. Market is anemic due to stagflation, economy, and unknown with tariffs. Wake up, sheeple. Right? Wake up, sheeple. Bert says, good evening. Only found you a month ago. I do your advice. Helped get out, right? I could restrict your loss, and thanks for your advice. You're great. No, Bert, you, my friend, you are great. You are great. Speaking of great, I'm ready to rank this video. What are y'all going to rank it? By the way, a new ranking system here. We got S tier, A tier, B, C, D, F. But of course, I want to know your numbers, right? Where would you rank this video here? I will say, now, granted, hear me out. I did mention earlier how his channel looks like to be a everything's going to crash all the time channel. I don't know. Maybe that's his clickbait. Maybe that works for him. But I don't know. Well, I mean, he gets it. He definitely gets it. So where y'all ranking this? I see 8s. I see 9s. I see a 6. Oh, very cool. Very cool. Nathan says he actually learned some stuff. Yeah, legit. That was good. Sete for him. That's a 7, by the way, which, dadgum, I knew somebody was going to do it. There are no 7s. Nobody gets a 7. Stop asking to put 7s on. No, we want you to pick. We want you to be, is it really good? Or is it not that great? Or is it bad? Nobody gets a 7. I know y'all like to play. I like to play too. All right, nobody gets a 7 here. But I'm seeing lots of 6, lots of 8s, lots of 9s. I missed the video, so you rank it at dadgum, Arthur. I like playing with y'all. Y'all are fun. 7.01. You could have gone 6.99, but you went with 7.01. I see what you did there. But he uses the unthinkable far too often in his videos. 6. 4.2. Ooh. Okay. I'm going to throw this in the A tier. I also will give it an 8. I thought it was very good. I have one feedback, and that's why I would actually really like to see where he gets his data from, right? Where he's like this orange line or this gamma squeeze thing going on. I would like to see more data. Like, give me your source. That's all I'm looking for here. But otherwise, I actually thought it was really good. 6 + 1. Give me that break. Hate that clickbait, but good info. Me 5. Yeah, that's all right. Ulyss. Don't buy dips. What about indexes? Indexes can't. Oh, they can't go to 0. Bro, anything can go to 0. I mean, that who knows what could happen, right? We would hope it can't go to zero. So for long term, buying dips should be a good opportunity. Or am I wrong? P.S. Thanks for your amazing work. Save me a lot of money. You are welcome, my friend. A lot of people feel that way. That in fact, Tom Nash and I, when we did have a chat the other day, he's like, you take a look at the SPY, right? And you zoom out on any time horizon and it goes up. There are times like right here, let's draw a line right here. There are times like here in 2022 where nothing happened until 2024. And so during that time, that was a waste of a couple years. But there's no guarantee that it comes back up. And then you can look at like the NASDAQ. We're going to have to zoom way out on this one, by the way. Go to monthlies. And this is, what happened? Yeah, here we go, monthlies. Oh, I already drew the line on it. This line right here came from March of 2000 all the way until 2017, right? So you could dollar cost average into this all day, but you also could lose money for 17 years before it came back. I, my friend, do not have time for 17 years of not making any money. So I'm going to try and run that outlier trend template every which way that I can north of Sunday. I'll put it to you that way. Let's go to today's member highlight over in our Discord. Where's the button? There it is. All right. Here was actually one that I was really stoked to share. This is Ryan. One of the first calls I bought pre-Chris's lessons was Nike Long. I've been waiting forever for it to do something and get out. Happy that my call for 78 strike was cleared out today with an 11% profit. And I'm not holding that bag on my dashboard anymore. So on the outset, hey, that sounds great. But I wanted to follow up with Ryan because I said, I'm really glad you mentioned this. I never keep losers in my portfolio. When I see something that's losing money, I don't just ignore it. I don't just hang on to it. I get it off my screen as fast as I can. When you start trading like this, winners become normal because that's all you'll ever see. Losers get wiped away because there's no point in holding them. And this was a real mindset shift for me. So I'm super glad that Ryan posted that. Now, I don't want to make this about me. I want to make this about you. How many times have you logged in your broker account and you're like, oh, I don't want to look at this one, right? In fact, one of the channels that I used to follow years ago, they would talk about getting black tape and putting black tape over that one particular line so they'd never have to, acknowledge the fact they're getting absolutely monkey hammered on this particular position. And I remember having a mental shift one day after I figured out how to trade, after I started working with market wizards, people who actually were making money in the market. And I was like, wait a minute, I don't have all that many losers, right? Every time I look at my account, it's just full of winners. It is full of winners. Of course, some are bigger, some are smaller. And the losers, like they're there for a couple days and then I drop them. But the only thing you should be seeing in your account are winners. If you're sitting there looking at losers day after day after day, something's not right. It's not supposed to be like that. Do not let any YouTuber, besides me, do not let any YouTuber tell you, looking at your account and seeing red, minus, 10,000, 20,000, whatever, dollars just going away is a good thing. Do not let any YouTuber look at your account and say, maybe you should be buying AMD as it's going down. Do not let any YouTuber tell you that it's supposed to be like this. Do not let any YouTuber tell you dollar cost average into stocks while they're going down, because only price pays. And this is going to break your brain. It's going to break your brain. But you need to buy high and sell higher. What? What did he just say? No, Chris, this is not how the market works, right? No, you can't buy high and sell higher. You can't make money doing that. Wait. No, you can't. You can't. Wait, what? Buy high and sell higher? Whoa. Wait, hang on. I thought you had to buy it low and then it goes up. Well, it might, but I would much rather be when it's already showing that strength and you've already got all these buyers there with you, pushing it up, right? You've got everybody there saying, buy. That's the way the market works. Buy high and sell higher. Breaks people's brains. But that's how it works. Super duper That is how it works. Now, I did see one other post that I wanted to share, book and podcast recommendations. I have my top 5 trading books in here. Number 1, New Trader, Rich Trader. Number 2, Complete Turtle Trader. Number 3, Trading in the Zone. Number 4, Trend Following, the 2004 edition, if you can get it. Number 5, How I Made $2 Million in the Stock Market. And I saw somebody actually found the 2004 edition as well. Where was that? No, somebody had it and they must have deleted their picture. Why'd you delete it? No, I was so stoked to share that. Who was it? Oh man. Anyway, somebody had posted that they were able to pick up the 2004 edition, and I was super stoked for them. No, I don't know what happened to it, so I'm bummed for them. The 2004 edition is written so much easier to understand than any newer editions, and so that's why I say if you can get the trend following edition, that's the 2004, that's the one to get. I just noticed this. Because gold is honest money, it is disliked by dishonest men. Whatever, Rand Paul, you're not the boss of me. All right, let's move on to the next section here. Where is it at? Be sure to share your stories in the Discord. And the first rule of OVTLYR is you tell everybody about OVTLYR. You tell everybody about it. It's hard for me to deal when the stock drops significantly during a single day. Like Alibaba's down 10%. It's hard to sell because dips seem like an overreaction. Sorg, again, I know you've seen this, right? Knowing you should sell your stock when it does something like that. When it hits your Sorg, you need to determine where you're going to get out. And you're afraid that it's going to turn around, right? I know it. I know it. And listen, we've all been there. I don't know how many times I've sold a stock that immediately goes back up. It just happens. It's part of the game. But if you don't, you could be right down here. You could be right down here really regretting that you hadn't taken your loss earlier, hadn't followed the plan that you made, right? So for sure. Follow your plan, my dude. I know it's 92% men who watch this channel. I know you're a dude. Hit the like button. Tell everybody else about OVTLYR 2. And of course, back to trading in the OVTLYR trading room. So at this point forward, we're going to be looking for short opportunities. And I'm going to show you exactly what I'm doing. This is your opportunity to ask questions. I will not be putting trades on. Ask questions as we go, because it's going to get really technical, really deep. And for those of you haters who say, I don't do anything, watch this. What is OVTLYR and how does it work? Old Uncle Warren used to say, be fearful when others are greedy and greedy when others are fearful. Now, to point this out, what are you saying here, if you want to think about it, is when someone says buy low, sell high, you actually want to be doing the opposite. Right? You want to be buying high and selling higher. That's what he's trying to tell you here. Now, of course, that's not how he trades. He does his own things. And I'm not claiming to be the Oracle of Omaha, but I am saying that I get the market cycle and how it works. So be fearful when others are greedy and greedy when others are fearful. OVTLYR shows you if investors are acting irrationally fearful or greedy and by how much, allowing you to get into the stock before the OVTLYR move happens. Now you can get into the annual pass for just 64% off, which is 82 cents a day. 82 cents a day? You got to be kidding me. But you can upgrade if you have a monthly trial, but just shoot us an email and we'll take care of the rest. Now, my style of trading using OVTLYR, I call the golden ticket trading strategy, and only price pays. It starts with the market, the 10 over the 20, price over the 50. From here on out, we're going to assume that we are in a bearish market environment. Here on out, we are assuming a bearish market environment. So we're going to go to the SPY. Those are monthly charts. Go to the daily. So the 10 is not quite under the 20. Price is under the 50. It might close there. And this is why I'm setting this up, giving you some practice, because we are very close to Shortsville here. Right. Superman may have been born in Smallville. We may be over in Shortsville. We'll just have to see here. Now, market breadth. We've talked about that ad nauseum. That market breadth has been going down for ages. So when the SPY has a sell signal, which it does, the market trend, we're going to theorize that it's bearish right now. The market breadth is bearish. Sector breadth. I went through. Most of the sectors are bearish except for, do I have the data here? Oh, sorry. I shouldn't have shown you this. This was a super secret project. Something super secret. It's coming very super secret soon. The hash is going to kill me. Energy sector and healthcare sector are bullish. Everything else is bearish. So just, that is a manual. is a manual step that that I take. I just look through each one. I just look through each sector. Like, is it bullish? Is it bearish? No big deal. So the next step that I would do is I would go and if I had any trades on, look to take off trades before adding new ones. These are my exit rules. Is I run the scanner. And on the scanner, I want to see a positive backtest using the outlier signals, over 1 million average daily volume, a buy signal, well, in this case, a sell signal, 0 to 5% move in the last 5 days. That's 0 to 5% up or down. All market caps wide open. I'm a snob, so I like $20 stocks or greater. Heat map would go from G0. Hang on, we gotta think opposite of this. So heat map for G's would go 0 to 50, and R's would go 0 to 40. The heat map moving down with a red overlay. Okay, that's what it would look like here. Now, of course, I'll need to make a new slide for this when we get to that point. But the next step after running the scanner or the screener, close a couple tabs. There, this is what the screener would look like. So positive returns greater than a million, sell signal 5 days, 0 to 5%, $20, heat map value 0 to 40, 0 to 50, moving down, and downtrend indicator. So the red background there. Only 2 popped out today. Nlock, I don't know what Nlock is, but I can't find it in TrendSpider. And I don't know why. I texted Mahesh and I'm like, what is this? So I have no idea what Nlock is. Like, TrendSpider doesn't even acknowledge it. Anyway, the only other one on here is Allstate. Now, when we look at Allstate next, there are a couple of rules that this breaks as well. First, it's in an order block. So I wouldn't be trading it inside an order block. Okay, so we're only talking theory here. I will not be putting on trades. And this would exclude me from taking any trades today, because if this is the one I'm looking at, it's inside a bullish order block because it's below. So I wouldn't be interested. Also, it's above the prior day's high. It's above the prior day's high. So the trend is moving upward. It's also going to close, it looks like, above the 10 moving average right here. So many, many reasons why I would not take this. Okay. So like I say, I'll redo these slides for bearish charts here, but for those reasons, I wouldn't take it. But I do want to show you, I want to keep on going here. And then if I were to look at the options chain, I would go to Allstate. Now, I'll tell you, and I know a lot of you have not traded options before. The very first time I ever looked at an options chain like this, I remember thinking to myself, what do all these numbers mean? I just want to make money. I don't even know what do all these numbers mean? I just want to make money. So I get it. I get it if this is the first time or first time in a while you've seen this. There was a question. Any chance of another lifetime offer being offered? No. We did offer a lifetime offer like 18 months ago, and that is super expired. Good question, though. Yeah, Mahesh is going to kill me. He told me specifically not to show that. Sorry. So I would be looking at in the money puts, which is on the right-hand side, calls are on the left-hand side. And let's go through my criteria real quick. I would be starting at 21 days to expiration. So this is March 21, which is 25 days out. Next, 250 or more open interest. So if we look here, our open interest is in this column here. The in the money puts, there's no volume here on the in the money puts. So another reason that I would not take this trade. Let's keep going. Less than 50-cent bid-ask spread. So generally I look at the 80 delta, so I'll start there. So I'll be looking at like the 200 strike right here. This is $3 wide. So not only are there only 23 contracts in open interest instead of 250, but this is $3 wide. Let's talk about why I would care about that. Why would I care about a $3 wide spread? Well, if I have to buy it, and I buy it at 13.20, okay, 13.20, and then I got to sell it back at some point. And if I have to sell it back, I'm only going to get $10.50 for it off the bat, $10.50. So that spread is $2.70. But what does that mean? That means if you want to buy it and then sell it back, you're going to lose 2.7 divided by 13.2. You're going to lose 20% in value immediately. You would lose 20% of your option value. You would lose 20% of what you put into this investment instantly if you wanted to sell it back. F that noise. No, thank you. Right. So that bid-ask spread of 50 cents, That's just a ballpark, right? Generally, it's a lot less than that. 20% or less extrinsic value. Now, we talked about how you could lose 20% of your investment immediately just by buying it and selling it back. Well, I also want to limit how much extrinsic value that I'm going to pay, which is over here. So $1.14 over 1310, 1.14 divided by 13.10 gives me 8.7%. So actually, I like that. Only 8% of it would have the time decay. Now the time decay goes to 0 on every option, on every stock, on every underlying, every time. You want to minimize that. So 20% or less is where I go. And generally, I don't want to have that expire. I want to roll this over as fast as I possibly can. But I'm going to make 2,000%. So I don't care about that. I know, Brian. So many people think that way. I'm going to make 2,000%. So I don't care if I buy and sell and I lose 20% off the bat, right? And yes, I am only looking at daily charts, but you can do something similar on any time frame. Options. I know, I get it, Joe. I get it. I nerded out so hard. This is my bread and butter right here. And generally it's around 80 delta. What is delta? Delta is the rate of change that the option will change in value for every $1 change in the stock price. So if the stock goes up $1, my 80 delta contract should go up by about $1. Or I'm sorry, by about 80 cents, right? So for every $1 in the underlying, my option contract should go up by 80 cents. Steve, what do you mean by roll over? I mean, like get in and get out. That's what I mean. We do roll the options. That is another topic. When the trade is working, you can keep the trade on, but roll it up to a higher strike or a lower strike in this case. Maybe that was a wrong term to use. What is gamma? Right? We talked about it's that magic rule that the market makers make, right? In fact, let's do this. Let's go back to ChatGPT and get ChatGPT to explain just what is gamma. What is gamma in options trading? So I want to make sure I don't mess it up. Gamma is a measure of how much the options delta changes. So here we're going to get real nerdy. Get ready. Put your nerdy glasses on like me. We're going to get ultra nerdy here. So this has a delta of 79. Okay. So imagine you're in a car driving 79 miles an hour and another car comes behind you and passes you and they're going 92 miles an hour. And you say, you know what? 79 is too slow. I need to go faster. I need to reach the 92. So you push your foot down on the accelerator. That rate of change of how fast you're accelerating from 79 up to 92 is gamma. So delta is the measure of how this, like I said, this gets really nerdy really fast, but I love this. Delta is the amount that the option price changes for $1 move in the stock. Gamma is a second derivative. Here we go. Gamma is a second derivative of delta, meaning how fast is the delta changing? That's all it's trying to measure. Brian says, don't forget theta. Right. Theta is that time decay, right? That's the extrinsic value we're trying to eliminate as much of because it always goes to 0 every time. Sounds like calculus. It's the change of the change. Yeah, exactly. It is exactly that. It is the change of the change. Precisely. So, again, I don't have any trades that I would put on, but I do want to spend a couple minutes with you real quick. Throw in the chat what you'd want us to take a look at. I'll look at 5. I'll look at 5 stocks. If they're an outlier, we cover 2,500 stocks, so there's a great chance. If they're an outlier, we'll talk about some buy and sell signals on these. So let's go first. Oh, man. Sid was on it in VO. He was ready. He had it queued up. He was just ready to hit the go button. All right, in VO, we've got our 5. I'm sorry, not 5. We've got our 10 over the 20, price over the 50 as of today. So that is a trend change as of today. But if we zoom out, it seems like it's on the opposite end of the market cycle, right? This seems like it had a very clear stage 2 uptrend, a stage 3, and then stage 4 downtrend. Now, could this be the beginning of a new stage 2 uptrend? Maybe. But to all intents and purposes, we got our 10 over 20, price over the 50. Let's look in outlier at it in VO. That's funny. Hims is out. Novo Nordisk or Eli Lilly, the better GLP-1 buy. Hims is out. We're in. That's just funny to me. We have a sell signal on this one. Let's zoom in a little bit on the 3-month chart. Steven said, best explanation I've heard. You are welcome, my friend. All right, we got a sell signal here. One thing to keep in mind, though, on this sell signal, it actually seems to be getting less greedy on this sell signal here. Now, this is the one stock. This is the one stock that we're talking about here, getting less greedy. I'm sorry, less fearful. Sorry, I get them mixed up here once in a while. Less fearful, moving towards greed, while this sector, the healthcare sector, has been moving from greed into fear. So you do have that divergence there. So just something to be aware of. But NVO looks difficult. I'll put it that way. Thank you for that very much. Intel, Joseph. I saw a lot of people chatting on Intel. Let's look at that INTC. All right. So this is one clearly I looked at a couple days ago. Kind of gave a little bit backstory on where my signals would have got me in, where my signals would have got me out. You've got your 10 over the 20, price over the 50. If price closes, it won't here unless something happens. Under that 10 EMA, that is a exit signal for me, hands down, no matter what. Let's go look at Intel on OVTLYR, INTC. And let's go to the 3-month. Nate says, Chris's explanations aren't at the preschooler level. They're at the level of interested investor. Oh, very cool. Very cool. Okay, so this INTC, like I mentioned, this is where G12 would have been the entry point on the heat map for me. The G12 gets a 10-point spread. So I would have got out of G22. So G12, G16, G18, and G23. So that would have been the exit signal on February 19th. Now, the greed is continuing to go up, but we do have this this divergence again. The tech sector is getting more fearful, where this one stock is getting more greedy. Again, the market's looking weak, but this stock has a lot of strength. So here, I will give you a rosy picture on Intel. This has a lot of relative strength right now, being that it's moving up, it's above its 10-period moving average. It's getting more greedy inside of OVTLYR while the market is selling off, closing under its 50-day. This is strong relative strength. So if the market were to turn around and go back up, this could be the one that gets like pushed up hardest and fastest. I'll put that out there. Intel could have a really strong run. So that was 2. Let's look at Bluefin Trader wants to look at Ally, ALLY. All right, you got your 10 under 20, price under 50. It's Jean-Louis, so I know Jean-Louis is looking for shorts here, aren't you? ALLY. Jean-Louis last week had a really strong short pick. I don't remember what it was, but he was on it. Like he was making bank. All right, let's go to the 3-month chart. And we can see here the greed had peaked right at that sell signal, had been getting more and more and more fearful. See how these are moving together, right? The financials is getting less greedy. Ally Financial, the stock itself is getting less greedy. So that's what you want to see. That's that contagion that we're looking for. Yeah, Jean-Louis, he's on the shorts. I knew it. I can read this guy's trades. I can see what he's doing. But Jean-Louis, you got an order block down here around 35.86. So you know the deal. If it pops down into that order block, switch to your 5-minute chart. And then if it continues on through there, I would just get out by the end of the day so you don't get into a situation like that. So, very cool. That was number 3. Let's do ACHR, Archer. I've seen a lot of people talking about this one too, ACHR. Okay, Archer Aviation, 10 under 20, price under 50. As of today, this is a bearish trend. You got earnings here in the next couple days. I don't know if it's going to continue to sell off into earnings or even past earnings, right? We're just looking at right now. This to me looks like a stage 1, a stage 2, and stage 3 is exactly what you see here where the moving averages start crossing around. So if it can hold, it might continue on. It really might, but a 10 under 20 price under 50 is a categorically proven bearish trend right here with an overhead order block. Let's go to OCHR or ACHR. Okay, Greg, you're next. That was a dare. You're next, Greg. All right. All right, let's see. This is loading up here. So ACHR does have a buy signal. The heat map is just not doing a whole lot right here. This is not, I mean, it's somewhat indicative of a sideways trend. You can kind of see that right there. But the sector industrials is getting more fearful. ACHR, in fact, just the last couple days is starting to get, the greed here is evaporating somewhat. So I don't love it, especially down 8% today. I would not love that one. But short, you never know. It might be a great one there. All right, Greg, where'd you go? HSY. We talked about this one the other day. This is an example of if you want to buy a stock, instead of buying it on its way down, hold tight, relax, and when it starts to come back up, hey, you can still get in at that same price, but you're going to get in when the momentum is at your back. So Hershey, not bad at all, my dude. Let's go to the next one, Fox. And that one, that is what a trend looks like, right? If any other YouTuber tells you need to be buying a stock that looks like, hold on, we're going to compare the two. We're going to compare this to AMD. Tell me if you can spot the difference. Can you spot the difference between a bad stock and a good stock? Can you see that? Like, imagine you're at the eye doctor, right? He's got you sitting in the chair. He's got those weird like binoculars on top of you. Which one of these would you rather buy? The one where you can buy high and sell higher, or the one where you can buy low and sell lower? I know which one I would take. I know for sure, hands down, which one of these I would take. And it certainly is not AMD. Certainly is not AMD all day. No, sir. Be sure you come back tomorrow. Listen, we are here to help you out as much as I can. Help you save time, make money, and start winning with less risk together as a team. YouTube is going to pop up a couple recommended videos. Bro, if you haven't clicked one of those, you need to already. And you also need to have a fantastic day. We'll talk soon.